Mixed signals from the economy, from earnings, but not from President Biden. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on whether we're headed for a recession after all.
The odds on that happening sometime in the next 12 months, I think, are pretty good, perhaps 70%.
Former IBM head Sam Palmisano on next steps for generative AI.
Business leaders and companies can show the way. They could establish the guardrails.
And Steve Rattner of Willett Advisors on how to invest in China.
On the plus side, I would say China's back. The flip side of it is that clearly they're a bit off balance.
Global Wall Street spent the week poring over a lot of data, looking for a signal in all of that noise. Big tech earnings surprised to the upside.
They have had such large gains in this sector, not even the sector as a whole, but these FANG names.
But most of the talk was about artificial intelligence and what it could mean for the tech industry, and for that matter, for us all.
AI is bigger than any single company or any single industry or indeed any single country.
And after all those encouraging earnings last week from the big banks, we learned just how bad things had gotten for Credit Suisse before UBS came to the rescue.
In 3 to 4 years' time, I like to see the employees of the combined organization, this country, our clients, to be very proud to be associated with UBS.
And then, at the very end of the week, reports came that the FDIC will put First Republic Bancorp into receivership, saying the time had run out for a private solution. President Biden was unambiguous in telling us that indeed he would like another 4 years in the White House.
Let's finish this job. There's nothing that we cannot do if we do it together.
And economic numbers pointed in both directions, with home prices and sales up.
If housing comes back, does that give the consumer another boost?
Consumer confidence down.
The consumer confidence number really interesting for April. So overall, it falls a touch.
And GDP numbers out Thursday mixed as well. Slowing in the first quarter, but not as much as some had feared. Then on Friday, we got consumer spending numbers and the all-important employment cost index showing spending was flat while the ECI moved up higher than expected, 1.2% for the first quarter. Markets took it all pretty much in stride, with the yield on the 10-year down about 13 basis points for the week, ending up at 3.439, while equities held up nicely. The NASDAQ was up almost 1.4% for the week, while the S&P 500 was up almost 0.9%, leaving it at 4169, or about 94 points above the median of where our L's projected will end the year. One of the most prominent of the L's, Mike Wilson of Morgan Stanley, is one of our most bearish. He's projecting a year end of about 3,900. And this week, he noted a shift. This is according to Mike. While macro news has taken a larger focus in recent weeks, the reporting season has the potential to refocus investors' attention on equity fundamentals. To take us through the week in the markets, we welcome now Greg Peters, PGIM Co-CIO for Fixed Income, and Mona Mahajan. She is Edward Jones' Senior Investment Strategist. Welcome, both of you, back to Wall Street Week. So, Mona, let me start with you. What about what Mike Wilson had to say? Are we looking at fundamentals now more than some of the macro factors we have been?
Yeah, look, I think Mike got it right this week. Certainly, markets were driven by those earnings results, and really the earnings results from the mega cap technology names. And as you noted, they surprised to the upside. And that wasn't only earnings beats. A lot of them are now showing that their business models are resilient, even through economic swings. And also they are showing off a little bit of their cash piles. We saw a couple of very big share buyback programs announced this week as well. And we saw at the end of the week, really, equity markets were bullish. They were positive for the week. And that came even despite softer than expected GDP data, inflation data that might be a little bit stickier than some might have hoped for. So generally, for the last couple of weeks, it certainly has been the earnings story driving markets and really driving those growth sectors in particular. But as we look towards the weeks ahead, especially next week when the Fed becomes more in focus again, and as the economy and inflation continues to remain to the forefront, I think we'll see a swing from earnings and equity fundamentals to macro picture becoming more in focus in the weeks ahead as well. But certainly right for this week.
Greg, what's driving the fixed income markets?
It is inflation, the economy, and what is the Fed going to do about it? So we're on knife's edge in fixed income, whether it's a recession or a soft landing. There's talk of stagflation still, of course. And the data are so all over the place and dispersed that you can basically draw a narrative or a conclusion from, the data in any way you want.
Well, so I'm curious about that because the 10-year yield, at least to my eye, has not been going much of anywhere anytime soon. Is that because people are happy with where it is, or it's because they can't just decide? Any way they look, it could go either way. They just can't tell. Yeah, and so that masks, what's underneath. And so what we're seeing, though, on an intraday basis, interweek, the moves are pretty extreme. So fixed income volatility remains really, really high. So yes, the 10-year is virtually unchanged this month of April, but the swings are pretty substantial. And Mona, what about in the equity markets? What are we seeing? The VIX is pretty subdued, is it not?
Yeah, it really is one of the key stories that has emerged over the last few weeks, which is that volatility index, some call it the Wall Street fear gauge, has been very subdued. In fact, down about 25% year to date, which shows a bit of complacency from the markets and perhaps a little bit of investors hiding out. Keep in mind, cash and cash equivalents are offering attractive yields. So if investors do want to wait for better opportunities, they certainly have an alternative now that is a pretty attractive alternative. But generally speaking, some of the catalysts that were supposed to emerge early on this year, including earnings, including the Fed potentially next week, and including this economic downturn, really haven't yet surprised in any material way. And so I do think markets have yet to see a meaningful catalyst. Perhaps the Fed pause that may be on the horizon will be that one.
Well, Mona, what about the possibility of recession? Because we still have a lot of economists saying that it's more likely than not, perhaps as high as 70% likelihood. I don't think I can see that very much in the equity markets. So do the equity markets know something the economists don't, or do the economists know something maybe the equity markets don't?
Yeah, look, I think this recession that is on the horizon is probably one of the worst kept secrets that's out there among economists and investors. Everybody has been talking about it. The deceleration we saw this past week in first quarter GDP has shown a slowdown from 3.2% in Q3, 2.6% in Q4 of last year. This quarter, 1.1%. So we're seeing this downward trajectory. The consumer is still holding up. But if you look at forecasts for Q3 and Q4 of this year, we are, in fact, seeing negative and slightly negative annualized growth rates. So in our view, this idea that a mild recession is on the horizon is very likely still, probably still a base case scenario. And markets won't be able to completely ignore that. But keep in mind, we did put in a lot of work to the downside over the last 15 months or so. The S&P went down almost 25% peak to trough. We don't see a repeat of that happening, even if we have a mild recession ahead. So any period of volatility, consolidation, pullback, we think could provide some opportunities for investors as they look past this bear market and perhaps towards a recovery period ahead.
Greg, what about the bond markets? Because we got a lot of economic data out this week, and it showed sort of slowing growth, perhaps. But inflation is not going away. Maybe headed in the right direction. It's not going away. Are the bond markets prepared for the possibility of the Fed hiking even past May?
No, in fact, the market's pricing in the opposite, right? They're pricing in rate cuts in the back end of this year. And to me, that is, the risk markets are ignoring that if the Fed cuts, that means we are into a recession or a much weaker period. But the binding constraint continues to be inflation. And I think we're in a very different environment. We've been so accustomed to the Fed coming to the rescue, and it's much easier to do that when they're operating below that 2% level. When they're above, and they're pretty meaningfully above, their degrees of freedom really, really get much tighter. So I think the markets are miscalibrating what the Fed can do. And the opposite is also true, David, where if the numbers continue to assert themselves on the inflation side, there's more work to do. And the markets have been consistently wrong on the level of inflation and what the Fed's response function is.
Yeah, as has the Fed. Quite often been wrong, as best I can tell. Greg Peters of PGIM and Mona Mahajan of Edward Jones. We're going to be staying with us as we turn to what a failed First Republic could mean for the markets. That's next on Wall Street Week, and we're on Bloomberg. This is Wall Street Week. I'm David Weston. The saga of American banks continued this week with news that First Republic is headed apparently for receivership. To talk about what that could mean for the markets, Mona Mahajan of Edward Jones and Greg Peters of PGIM are still with us. So, Greg, let me turn to you first. We don't know exactly what's going on with First Republic. Let's assume it does go into receivership, as reports right now say it will. What does that mean for the markets as a practical matter?
I think what it means is that the market will continue to search for the next weakest link. And so First Republic has been very much in the market, the past month or so. So it's not a complete and utter surprise, but the markets are really looking to suss out the weak players to see whether it's systemic or not. But I think the real issue on the table is how broad is the pullback in lending on the regional and community bank side, and what influence does that have on the market and the economy? And that contraction of credit is really meaningful because it goes to the small and medium-sized businesses, which, quite frankly, are the lifeblood of the economy and the labor market.
So, Mona, what does it mean potentially for equities? In fact, we continue to contract on the credit side because the banks are under control, under stress, and they get more and more conservative as a practical matter.
Yeah, it certainly has been interesting on equities, of course. Financials have had some difficulty this year, and in fact, still down year to date, one of the worst performing sectors on the S&P 500. And part of that, of course, is the banking turmoil we've seen over the last month. And now with First Republic coming back to the forefront, really the question, to Greg's point, is there another shoe to drop after First Republic? And market uncertainty, of course, is never welcome by investors. But what we would say is, one, the bank tightening of credit, and that actually had started even prior to the March turmoil. We started to see metrics like the Senior Loan Officer Survey starting to show meaningful tightening. So what that means is banks will make it harder for consumers and corporations to get loans. Now that's a double-edged sword. On one side, yes, economic activity will cool and the economic growth prospects look worse. But on the other hand, that inflationary story we've been talking about could see, a marginally less pressure on inflation moderating even further because banks are pulling back and consumption and corporate spending may thus pull back as well. So really we're watching both edges of that story, or both sides of that story. But more broadly, we'd say the volatility that we've seen in the financial sector, we think probably has some room to run here. But one final point there, we don't yet see any systemic disruption or any scope for a systemic disruption to the U.S. or global banking system. We do think large cap banks here in the U.S. are still sound and in much better shape than they were back in 2008, 2009. So that provides a bit of comfort this time around.
Greg, Mona makes an interesting point here. To what extent might the disruption of the banks, which we don't wish on anyone, goodness knows, but could that actually do part of the Fed's work for it? There was a piece actually in the Bloomberg this week that said that what we're seeing already on the credit side is amounting to 1 or even 2 rate hikes.
No, absolutely. The inflation growth dynamic is reflexive, right? And the Fed knows that. And so if you hit growth hard enough, if you just take it to extremists, if you really hit growth hard, inflation will follow lower, right? So the stagflation fears, I think, are a little overblown. I mean, we do have a 15% probability of it, but ultimately, if you really hurt the economy or the economy really starts to roll over, inflation will likely follow.
Thus far, Mona, I think the consumer has really carried us through here. What do you see in the consumer, and can they keep doing it?
Yeah, it's a great point. And really, the resilience of the consumer has been remarkable through a few very tough quarters. And in fact, the GDP print we got this quarter for the first quarter of 2023 showed the same trend. Yes, GDP growth was at 1.1%, but consumption and personal consumption, 3.7%. So still, above trend levels, the consumer is spending. What we've been hearing throughout earnings season, though, is that towards the end of the quarter, perhaps we did start to see a little bit of pullback in consumption. And in fact, we're facing an environment where yields are continuing to move higher. We are seeing a bit of volatility in the housing market. And of course, the all-important figure, which we'll get next Friday as well, that jobs number. Unemployment in the U.S. still at historically low levels, 3.5%, multi-decade lows. But what we're watching is some of the real-time indicators of labor as well. We are seeing jobless claims, weekly jobless claims tick higher, job openings tick lower, all kind of precursors to a little bit of softening in the labor market. We don't expect dramatic softening, but the Fed is hoping that the labor market cools to some extent so they can see that wage growth figure cool as well. So, all in, consumer resilient, but probably seeing incremental weakening in the weeks and months ahead.
One last thought. We couldn't finish a discussion of credit without talking about commercial real estate. Greg, where are we in commercial real estate?
Well, I think we're in the early stages still. So, the work that we have looked at and evaluated is that we're in, we're calling it the fourth inning or the third inning still. So, this is a long tenured process. So I think we're very much in the first stages. The higher rate environment has pretty meaningful implications for commercial real estate, but actually most borrowers. So, this story has yet to unfold.
Yeah. Third inning, huh? We got a long ways to go. That's a little
Third
sobering.
or fourth.
Third or fourth, okay. Thank you so much to Mona Mahajan of Edward Jones and also Greg Peters of PGIM. Coming up, generative AI. Everybody is talking about it at this point. What does it mean for all of us all around the world? But if you're a CEO, what do you do with generative AI? We're going to ask former CEO of IBM, Sam Palmisano. He's been through a few of these technological changes, and he has some advice for CEOs about how to handle generative AI. That is coming up next on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. In a week full of big tech earnings, all the talk was really about generative AI, its potential, and also some of the potential risks. To take us through those, we welcome now Sam Palmisano. He was the chairman and CEO of IBM. He now is chairman of the Center for Global Enterprise. So, Sam, great to have you back with us on Wall Street Week. Let me put you back as either CEO of IBM or another huge corporation, publicly traded. What would you be doing right now today to prepare for or to incorporate AI?
Well, David, it's an excellent question. And as I think about it, I would think about all the lessons I've learned in the past, either running IBM or if I was currently a CEO, what I've learned over the past 10 or 15 years. And that is that we faced these challenges before. There's always been these disruptive technologies that come along. They represent from phenomenal promise, but also they can be disruptive. There are a couple of different paths. I mean, I'll make some suggestions, but you could dismiss it. You can wait and see, but then we learned in the last time that you can be left behind if you do that, and other leaders emerge in your peer group. Another way to do it is let it just go. Like that would be the early days of the internet. Just let it run, and then the problem is then you have to clean it all up, and that takes time. You lose some momentum, also costs you some money and those sorts of things. But I would start with create a management system that takes advantage of these technologies in your strategy. Implement that company-wide. The benefit of starting there is you won't have the problems of the past with digitization and the internet. And plus, you can scale and integrate and learn a lot quicker once you get your footing and you know where you want to go to take your business. The other thing is that I'll add is these technologies are going to mature, and they will. I mean, there's a lot of innovation yet to come. As exciting as this is, there's a lot more to happen here, and it has to happen. There are gaps that need to be filled. Having said that, it becomes ubiquitous, which means it touches everybody in your workforce. So you have to think about the jobs, the nature of work, and how it changes, how you develop skills. And it's not go out and hire 3 data scientists. You're going to have to train and educate your people across the entire enterprise. And the last one I would ask them to think about, or I would think about, is culture. Culture is so important. You need to adopt ethical principles for AI. We see the issues today for companies that haven't done that. You need to be trusted in this space if you're an enterprise. But they're the things that a management system, think about learning of your employee base and the impact to them and your culture.
One of the issues I suspect is productivity. I mean, generative AI has the potential at least to really increase the productivity of a company, something that we're always looking for. How do you make sure that you take advantage of that as a CEO without letting it go too far?
Well, that's exactly the point. It's fundamentally what you need to do is, I would say, you need to think about the technology as a complement to what's going on today. So therefore, your knowledge worker can become an expert, not just an average knowledge worker, or a teacher can become an expert teacher, not just a participant in teaching grammar or language, whatever it happens to be. So if you think about it that way, is that how do you complement the technology with the actual the worker, the knowledge worker in your organization. I think if you do that, you won't have all the chaos that occurred historically. I mean, chaos was okay. We learned. I mean, so there's nothing wrong with learning, but let's take the learnings of the past and try to avoid those as we get into the future here.
Sam, what is the role, if any, of the government in all this? There's a lot of talk about regulation. We already saw China come out with a draft set of regulations, basically saying, whatever you do with this generative AI, it's got to be consistent with our values, which is all the censorship that comes with that. So when it comes to U.S. government, Europe, India, what is the constructive role of the government in really directing AI in constructive ways?
Well, I think government does have a role, and we see what happens when government's late to get ahead of these kinds of issues. You see that today with the social media companies and the issues around data and data privacy. So there's clearly a role, but the challenge is, as we know and as we've learned, these regulations and standards have to be global. I mean, standards will emerge over time that are global. That takes a long time. So in the interim, what does a regulator do? And that's, you laid out the problem, David. That's where it gets complicated because there's different systems. There's I'll call it the Chinese control system. There's the open system of the United States and let's say some of the West, but then Europe somewhere in between. So how do you get global regulation that's consistent? And to do this regionally just won't work. It won't work because fundamentally these platforms are global by definition. They're open source software by definition. So I know regions think they can take control, but the technology moves so fast, they will really struggle in doing so unless you completely shut the place down and you wall it off. And that has economic implications. So to me, the question is, in the interim, what do you do? And I think there's a role here for business leaders and companies. I think business leaders and companies can show the way. They could establish the guardrails, the principles, ethical transparency, and implement this themselves.
And finally, Sam, this week we had some of the biggest tech companies reporting earnings, and almost all the discussion was really about AI and generative AI and its potential. And there are people in the street, you know this right now, who are saying maybe this will give a new impetus to the tech sector generally. It had been such a growth sector for so long, then it was waning just a little bit in the growth. Now they say, well, this is a whole new wave. Do you think they're right?
Well, it's definitely going to be a huge growth and innovation opportunities. There's no doubt about it. The question, though, David, is who emerges as the winner here? So I'll take you back a little bit in history. If I go back like 50 years of the tech industry, it's interesting to see these patterns that who emerges as the winner. Take client server to cloud. Surely Microsoft was the winner with Intel, the technology provider in client server. Who's been the winner? There's no doubt Amazon's the winner. Let's go to the current world, I call it hyperscalers and large data model companies, social media. We know who the winners have been. Obviously, it's the Facebooks, it's the Googles, it's the Apples of the world, have done very, very well in this environment. Who's going to emerge in the future? That's the question. I mean, because some of these things can be disruptive to the business models, especially to things like advertising and search. It could potentially be disruptive. At the same time, a lot of these issues that still exist that need to be resolved as far as let's call it the governance of the data, the transparency of the data, the issues around the fact that there's bias and it needs to be addressed. All that has to happen. The scale required to run these models, David, a use case for a large language model, literally to get one use case is $100 million of infrastructure. I mean, that's not going to happen. It's almost like semiconductors. And so this will all have to be addressed. And there's tremendous opportunities. So I think really the question for our colleagues, especially from an investor perspective, is who's going to win and where do you place your bets?
Sam, thank you so much. It's always a treasure to have you back on Wall Street Week. That's Sam Palmisano, the former chairman and CEO of IBM. Coming up, we're going to go to China with Steve Rattner of Willett Advisors, and we'll talk with him about the investor strategy in the Middle Kingdom.
If you really try to create a balance sheet for China, you would be envious of that balance sheet relative to our balance sheet.
That's next on Wall Street Week on Bloomberg. China and the United States. What was an afterthought when President Nixon went to China in 1972 has now been catapulted to be the most important economic relationship in the world, as the Chinese economy has grown more than sixfold, trailing behind only the United States. And the U.S. helped it get there, leading the move to admit China into the WTO.
Bringing China into the WTO is a win-win decision. It will protect our prosperity, and it will promote the right kind of change in China.
And there's no doubt that U.S. trade with China has grown dramatically since the end of 2001, when China officially joined the WTO. But now the question is whether both sides truly did win from that deal, with calls for restrictions on trade with China and investment in China.
All these things are increasing tensions, and it scares a lot of institutional investors that would be normally willing to put a lot of money into China.
And an outright ban on social media giant TikTok.
The potential security, privacy, content manipulation concerns raised about TikTok are really not unique to us.
Even as Secretary Yellen says decoupling of the two largest economies in the world is not an option.
The United States will assert ourselves when our vital interests are at stake, but we do not seek to decouple our economy from China's. A full separation of our economies would be disastrous for both countries,
leaving investors to question what to make of the Middle Kingdom as an investment opportunity, as companies like Apple pull back.
7% of their iPhone production now coming from India. That's up from 1% in 2021. This is about diversifying away from China.
And to give us an investor's perspective on China, we turn to a significant investor in China. He is Steve Rattner, Chairman and CEO of Willett Advisors. That, of course, is the organization that invests the personal and philanthropic money of Michael R. Bloomberg, who owns and was the founder of Bloomberg LP. So, Steve, welcome back. Great to have you here. You've just been over to China. I know that you have invested in China over the years. What did you learn from your trip?
I think I learned two things, David. On the plus side, I would say China's back. Other than people wearing masks, you would have no idea that ever been COVID. They're humming along. They're hard at work. We met up with a lot of startups and entrepreneurs and venture capital kind of people, and they're very focused on building their businesses. The first quarter GDP number is 4.5%. You know, people say, okay, it's a slowdown from 7%, but it's a great number, certainly compared to our 1.1% for our first quarter. And so they're humming along. The flip side of it is that clearly they're a bit off balance, both by what America has done to them and the state of the relationship with the U.S., and also, frankly, with Xi, who came in with an economy that had really moved heavily toward market-based activity, market reforms, and he dialed a lot of that back. And now he's trying to walk it sort of back the other way a bit, but the Chinese don't really know where that's headed, or what. There's no transparency what to expect.
We tend to focus on the geopolitics, the relationship between the United States and China, but you make a really important point. If you're simply a businessman in China trying to make decisions in China, you don't have the certainty that maybe you thought you had before. And what does that do to their willingness to make investments, to take risks? Because you're not sure when the government may come crashing in, as frankly they did in the tech area.
Exactly. And so the problem was that a couple of years ago, when Xi decided that the tech industry had gotten too big for its britches, he also got onto this sort of common prosperity theme, which is fine, you know, less income inequality. But then he started randomly picking on sectors like online education, which he more or less shut down in a day. And so it was very interesting for me to watch this. And so then Xi gave some speeches and kind of outlined what he thinks China ought to be focusing on, things like renewable energy, new technology, stuff like that, hard tech as we call it. And so as we talked to our investment managers, they suddenly pivoted. And they're essentially listening to Xi and saying, well, if he wants us to invest in A, B, and C, then we better go invest in A, B, and C and not X, Y, and Z. So there's a lot more trying to figure out what he wants and trying to follow it.
As you talk to your investment managers, are there some areas they think are safer in the sense it's less likely the government will get involved in that?
Yeah, I think certainly industrial. Like I visited a company that makes gears, very high precision gears. Their business is fine. You know, they're a leading manufacturer. He doesn't care about who makes gears for electric vehicles and things like that. So sure, and then there's a lot of activity in things like robotics and so on, where again people feel very comfortable. This is where Xi wants them to go. Everything related to battery technology, anything to do with energy and climate, all, you know, great. Let's go there. But more careful about the so-called sensitive sectors. Involving anything involving content, the media, things like that.
You talked about growth in China, which is not what it was, but still, as you say, enviable for much of the world at this point. One of the things that we read about is that the nature of their growth has shifted from essentially an export-driven growth to internal, to developing their internal markets. Does it change the sorts of companies, the sort of investments you look at?
It's a great question. Yes, this is something that people sort of have suddenly started talking about, but it's been underway for a long time. China has been not just an export-driven economy, but an investment-driven economy, huge savings rate. And for a decade, everyone, including the Chinese government, has been trying to get consumers to consume more and create more of a domestic economy. And that is starting to happen. The implication of that is as investors, is that there's a lot more focus today on the domestic stock exchanges, the Shanghai Stock Exchange, the so-called A shares, where domestic companies that make things for local consumption tend to be listed, because that is what investors perceive to be China's future growth engine, and less emphasis on, for example, the New York Stock Exchange, where a lot of the Chinese tech companies are listed, because people are worried about where they're headed.
There was a time a few years ago when there was wild fluctuation in the Shanghai exchange, in the domestic exchange, in part because, as I understand it, a lot more of the shareholders really are retail. It's not institutional. And so you could have retail investors really move quickly. Is that still the case, or is it becoming more driven by institutional?
It's somewhere in between. Everything you said is exactly right. That's the way it was. Institutional money is now coming in, so the market is getting institutionalized. This is not a market in which I would recommend individuals go out and buy the index, for a couple of reasons. First, the one you said. Secondly, there are still a lot of state-owned enterprises inside of that exchange. And although they've actually done well lately, better in fact than non-state-owned companies, in general, we don't perceive them to be the thought leaders or the great engines of growth of the future. So a market like Shanghai is one where a good money manager can actually create a lot of so-called alpha, outperform the index, because there's so much volatility and junk inside that index.
So as an investor in China, how concerned are you about leverage? We've heard a lot about really extreme leverage in the Chinese economy.
Well, certainly company by company, we don't invest directly in companies very often, but our managers hopefully are looking at leverage. I think leverage across the Chinese economy is a little bit missing the point, in a sense, in that people are looking at the liability side of the balance sheet, but there's also an asset side of the balance sheet, which is they own a lot of stuff, including over $1 trillion of our treasuries. And so they also, I think, if you really try to create a balance sheet for China, you would be envious of that balance sheet relative to our balance sheet in terms of the level of the assets, because of all that saving that we talked about, the level of the asset accumulation that's occurred along with the leverage on the other side.
Steve, you mentioned the uncertainty, maybe some would call it even anxiety, about the U.S.-China relations, two largest economies in the world, and there are a lot of hostile things being said on Capitol Hill about China at this point. How realistic is not decoupling, because Janet Yellen, Treasury Secretary, said it's not going to decouple, but a movement in that direction, what that could do to the Chinese economy, but to ours as well?
Well, two things. First of all, I was really surprised for the first time in my meetings with the Chinese, our investment managers, that in addition to answering our questions, they had questions for me. They wanted to know about the Chinese-American relationship. They wanted to know what to expect from the Biden administration in terms of export controls. They are very off balance about the state of the relationship with the U.S. I think Janet Yellen's speech was excellent. I read that whole speech. There can never be a complete decoupling. We get all of our bicycles from China. We get all of our toys from China. You're not going to be able to resource those from other places. But yes, it's like, if you think of it as a spider web, the spider web is starting to disentangle a bit. The Chinese are very focused on the possibility or the desirability of trying to make more of their stuff outside of China, so that it's not, quote, Chinese anymore and would come into the U.S. more easily. So it's a bit of both, but we also have to recognize there's a cost for both economies associated with this decoupling. The coupling helped us have very little inflation over the last 10 years until recently because of lower costs. As you decouple, by definition, you're sourcing stuff in a more expensive way, and obviously the Chinese are losing business. So it is really a lose-lose. There's obviously good national security reasons to try to reduce our dependence on them, but nobody should kid themselves. It is a lose-lose.
One last one. China has been known for restrictions on currency, capital flows outside of the country. Last week on Wall Street Week, Larry Summers said one of the reasons we don't need to worry about the RMB displacing the dollar in reserve currency is because nobody wants to put their capital in there if you can't get it out. As an investor, do you take that into account? Is that a problem for you?
No, I don't think so. We can get our capital out, and yes, I mean, you can worry a little bit about what they could do, but I don't think that's a significant worry. I thought what you were going to ask me, and I would agree with Larry, that the RMB can't become a reserve currency. You can't have a currency that is managed and with capital controls become the world's reserve currency, and with a government that is so unpredictable. So I think probably the last thing I worry about is the idea that the RMB is going to displace the dollar.
Steve, thank you so much. Always great to have you on Wall Street Week. That's Steve Rattner of Willett Advisors. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We're joined once again by our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. So, Larry, thank you so much for being back with us. We had a lot of important economic data this week. We got the first quarter GDP numbers. We got personal spending. We got ECI. What was most important for you?
David, I've been pointing to the ECI number because I think the labor market is the key to the inflation process, because it only comes quarterly, because it's the best of the numbers for measuring wage inflation, because it includes benefits and adjusts for changes in the composition of the labor force. And that number was pretty strong. That number's running at about 4.8% now, both on an annual basis and a quarterly basis. There's not really evidence that it is decelerating. The revision for last quarter was a little bit upwards. And 4.8% labor cost inflation just does not go with 2% underlying inflation. So I think we've got a bit of a stagflationary problem developing, where we have a base inflation that's well above target. And as I've been saying for the last year and a half, I don't think that's going to get back to target without a meaningful slowdown in the economy. That doesn't mean the Fed's objective should be to induce a slowdown, but if the Fed does what's necessary to contain inflation, I think a slowdown is likely to come along, and the odds on that happening sometime in the next 12 months, I think, are pretty good, perhaps 70%. So I think we're not looking at an easy situation facing the Fed. Given these numbers, I think it's pretty clear that the Fed has to go ahead and move rates in May. Given the emerging credit problems, I think June is very much an open question. So what I hope we'll see from the Fed is a move upwards by 25 basis points in May, followed by a commitment to monitoring both the activity and inflation figures on one hand and the credit flow issues, which are leading of the economy, on the other.
So, Larry, there was a thought, not a hope, but a thought that perhaps some of the difficulties we had at Silicon Valley Bank, then Signature Bank, and now First Republic Bank might slow down the economy on its own so the Fed wouldn't have to go as far. We thought maybe these were behind us. We now still have issues that lurked up with First Republic. What do you make of the way that's being handled as opposed to the way Silicon Valley Bank was handled?
Let me just say first, David, that I am very connected to people all over the financial sector, but I have no specific relationship of any kind that I know of with First Republic Bank. I'm surprised and disappointed that this situation has continued to linger as long as it has, with the bank stock down 95% and various other credit indicia of it in a problematic direction. Look, the big banks and the government both have a strong stake in this situation being contained and resolved. The big banks have deposits in First Republic Bank in significant quantity. They have a huge stake in the financial system staying stable.
Larry, let's take a bit of a longer view here now about where we're headed globally with our economy. We had Jake Sullivan, the National Security Advisor, give remarks at the Brookings Institution this week where he laid out what I took to be sort of a framework under the Biden administration where he wants to go with economic policy. What did you make of that speech?
Jake is a very thoughtful leader, and it's probably the most carefully, intellectually developed exposition of the administration's philosophy that we have had to date. And certainly he's right that the world has changed. He's right that China represents a new kind of challenge. He's right to emphasize, after what we've seen in Europe with oil, other things, the importance of resilience. But I was disappointed that the speech did not emphasize the central importance of importing low-priced goods. That is a substantial part of what determines the living standards of Americans. That is a substantial part of what determines the competitiveness of American producers. For example, we have 60,000 people working in the steel industry and 6 million people working in industries that use steel. So when we raise the price of steel, we are hurting people. The Peterson Institute estimated some time ago that trade reduced costs for consumers by more than $1 trillion. And if we had removed our tariffs on other measures against China, it would have added 2% to people's real incomes by reducing inflation pressure. I think that the administration is much too quick to move to industrial policy strategies on grounds of resilience. Let me give you 2 examples. The Jones Act was the resilience policy of the 1920s. Let's have all our shipping be U.S. carriers. That's made the price of heating oil considerably higher in New England all year. That screwed up our efforts to help Puerto Rico after the hurricane because we didn't have adequate supplies. We had a major infant formula problem in this country. That was related to Buy American policies that meant we couldn't turn quickly to European supply chains. So, of course, we're all for resilience. We're all for strong U.S. producers and strong U.S. businesses. But what I find missing in the approach is helping consumers, which after all is the middle class and is central to how people feel they're doing, recognizing the importance of cooperation in producing a more prosperous general global economy that works to our benefit, and the United States maintaining its commitment to other countries, which we have not done in the trade area for quite some time.
Larry, let's leave our audience on Wall Street Week here with a quick round of long-short, whether you're long or short certain issues and certain people. Let's start with President Biden's launch of his new re-election campaign. It happened this week. Are you long or short on it?
I'm long. I think that the administration's got a lot that it can run on, and frankly, its opposition is in very substantial disarray.
What about the head of the Bank of Japan, Mr. Ueda? He had his first meeting this week and surprised some people about sort of putting off ultimate decisions about yield curve control. Are you long or short on his premiere?
I think he's a cagey and shrewd guy. any kind of peg, whether it's an exchange rate or an interest rate, is a hotel that's much easier to check into than to check out of. And I think by setting forth that study mechanism, he is beginning a process of orchestrating leaving a peg that probably has outlived its purpose.
And finally, we talk about the Fed a lot. We don't talk about Fed security very much. This week we had this remarkable incident where apparently some people who were apparently Russian purported to be President Zelensky of Ukraine and got Jay Powell, the chair of the Fed, on the phone and had a fairly detailed discussion with him. You're long or short on security at the Federal Reserve?
Oh, I'm short looking backwards and I'm long looking forward, because I'm sure there's going to be a pretty thorough review of how that could have happened that's determined to make sure that doesn't happen again. That's kind of an embarrassing moment. If there's any institution in the United States we want to be unconnable, I would suggest that it's the Fed. But there are a lot of very dedicated people there, and I'm sure they'll get it fixed.
Okay, Larry, thank you so very much. Always a pleasure. That's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, the richest man in the world gives New York a brand new gift from Tiffany's, and he spares no expense. This is Wall Street Week on Bloomberg. Finally, one more thought. All that glitters may not be gold, but some of it sure is. This week marked not one, but two milestones for luxury, and particularly for the largest luxury company in the world, LVMH, or more correctly, LVMH Moet Hennessy Louis Vuitton. This week, the market cap of LVMH touched the $500 billion mark, making it the first European company to do that. Run by the world's richest man, he's Bernard Arnault, who has added the names of some of the best-known luxury brands to the name of his company as he's acquired them. But one iconic luxury brand name didn't make it into the company's name. That is Tiffany, whose flagship store at 5th Avenue and 57th Street, Audrey Hepburn made iconic in Breakfast at Tiffany's.
Don't you just love it?
Love what?
Tiffany's.
And that brings us to the second milestone of the week. When LVMH bought Tiffany's back in 2021 for $16 billion, a renovation of the 5th Avenue store was already underway, requiring them to move all those jewels to a safe location, hoping to avoid the sort of thing that happened in the Italian job.
What happened to my truck?
LVMH won't say how much it all cost, but it does include works by Basquiat, Damien Hirst, and Rashid Johnson, as well as a restaurant from Daniel Boulud. So finally, you will be able to get, indeed, breakfast at Tiffany's. The transformation of what they now call the landmark Tiffany store has been overseen by one of Mr. Arnault's 5 children, Alexandra, who, it turns out, is going through a process with his father and his siblings, as Mr. Arnault has restructured his company to redistribute the power among the 5, with whom he has monthly power lunches, all in an effort to avoid that ugly succession process dramatized in the HBO series.
I've always tried to do the best by my children because I love them.
Have you thought about the possibility that your children are actually scared of you?
Oh, f*** off.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.